In this video, we explore in detail Dragonfly Doji, Gravestone Doji, Hanging Man, and long wick candlesticks. So, if you find this topic is useful for you, make sure to press the like button, and if visiting first time, don't forget to subscribe and turn on notification bell, so you never miss our latest update. I'll meet you after intro and disclaimer. Let's first understand the Dragonfly Doji. The Dragonfly Doji is a single candlestick formation made up of one candle. When this candle appears, sellers drag the price downward after the candle opens, but buyers step in at lower levels, lifting the price upward, closing the candle near the opening. This shows sellers have failed to keep the price suppressed, and buyers are dominating sellers. This creates a Dragonfly Doji, a dragonfly-shaped candle with a long lower wick visible on the chart. The candle body in this candle is minimal, and the lower wick is far longer than the candle body. The Dragonfly Doji candle signals rejection from lower zones in the market. The color of this candle does not matter. It may be either red or green. Candles occasionally show a tiny upper wick. Let's view this example. This is a 5-minute chart. Right after the market opens, the price is rejected from lower levels and forms a long wick candle on the chart, which we call a Dragonfly Doji candle, indicating a bullish reversal. This shows the market is attempting to set support at this level. So buyers persistently try to push the price higher, making the price trade within the same range for a certain period. When sellers fail, buying pressure builds in the market, and the price breaks this range with a strong green candle and moves upward. If a green bullish candle appears after a Dragonfly Doji candle, you can take a long trade by placing your stop loss below the support zone. A Dragonfly Doji candle forms near a strong support zone, increasing the likelihood of a market reversal. Let's now study the Gravestone Doji. This is also a single wick. This candlestick pattern develops when buyers with strong bullish intent push the price higher, forming a strong green bullish candle on the chart, but at higher zones. Sellers are present. They enter and force the price downward, causing the candle to close near its opening. This produces a small body candle with a long upper wick on the chart, which we call a Gravestone Doji candle. In this candle, the candle body is much smaller than the candle wick. Because buyers lack strength, sellers overpower them, pushing the price down from its peak. A Gravestone Doji candle works as a bearish reversal alert. Let's view examples. This is a 3-minute time frame chart, where the price briefly drops after the market opens, but receives some support from the lower level and moves upward, but cannot break its day's high. Facing rejection from its day's high, it declines, forming a Gravestone Doji candle with a long upper wick on the chart. Here, buyers attempt to lift the price from the lower zone, but fail to break the day's high due to weak buying pressure. This reveals a strong rejection from the day's high in the market. It is acting as a level. After some time, the price breaks the day's swing low with a strong bearish candle and drops sharply. Now let's examine the Hanging Man candle. The Hanging Man is a single candlestick formation that appears when the market is in a short-term uptrend and the price approaches its closest resistance area. As soon as the candle opens near this resistance zone, sellers enter the market and pull the price downward. However, the price recovers and closes near its opening point. Here, buyers gain strength from the lower levels and lift the price upward. However, as the price nears the resistance zone, sellers begin entering the market, expecting resistance at higher prices. This causes the candle to briefly fall, forming a Hanging Man candle with a long lower wick on the chart. Here, the market fails to maintain its prior bullish momentum, preventing a breakout of the resistance level. Sellers slowly begin exiting, causing the next candle to close at lower prices. This worries buyers and they start booking profits, leading to selling at higher zones. The pressure rises and the price drops sharply as it breaks the low of the Hanging Man candle, above or below the high of the Hanging Man candle. You can take a short trade by placing a stop loss slightly above the resistance zone. Let's review how to trade multiple long wick candles. Whenever the market is in a downtrend and the price nears its closest support level, such multiple long wick candles appear on the chart. This suggests that the previous market trend is slowly weakening. Sellers are aggressively selling from higher zones, pushing the price downward, forming large bearish candles. However, as the price reaches the support area, It faces rejection from the lower zone, creating a long wick on the candles. Sellers repeatedly fail to close the candles lower. This shows that selling pressure is slowly reducing near the support zone, allowing the price to trade in a range inside the support region. Seeing sellers weaken, buyers begin entering the market, and the price breaks this range and moves upward. For example, if we examine the 5-minute timeframe chart here the price moves down at the start of the day forming large bearish red candles, but after 10 a.m. the market begins moving up forming candles. The size of the candles keeps shrinking and a long wick starts forming on the downside. This means that the strength of sellers in the market is fading, causing the price to trade in the same range and forming a support zone on the chart. The momentum that existed in the market during the early session has now reduced. Also, on this day, weekly options expire due to which the premiums of the put options of sellers selling from higher zones would have increased rapidly due to this momentum. However, as the market speed slows near this support zone, the premiums of their put options begin falling quickly due to theta decay, causing their profits to shrink. The longer the market trades sideways in a range, the more anxiety rises for sellers as they watch their premiums drop. After some time, the market breaks out of this range and pushes upward, and seeing this, buyers start purchasing in the market, due to the market trading in this range for a long time. The profits of the sellers begin decreasing, causing them to fail to preserve their money. Exiting positions increases buying pressure and the price rises rapidly, triggering the stop losses of all sellers. This way, you can trade without watching a single candle on the chart. By observing the action of multiple candles, we can identify a good trade setup in the market. That's it, traders. Thanks for watching this video. Average is crowded, but excellence has room. If this video pushed you to think beyond average, press like and support the channel. And if you're new, subscribe and hit the bell so you're never late for the next strategy. Guard your energy, sharpen your habits, and learn what others overlook. The advantage is in the details. Stay disciplined, stay uncommon, and I'll see you in the next video.